Greetings. I appreciate you joining us today. I'm pretty excited about today's video. It's sort of a mundane sort of thing, but something we all need to know about, and also it's been a hot potato in the Sun Plus world for at least a few years, and that is how to do prior period adjustments in the Sun Plus world. And prior period adjustments are caused by prior period errors. And so I have a document we're going to work through and talk about, and it's possibly you could just read the document. It's going to be connected to this video in a way that you can get it yourself, but I think it might be useful to have go over it with you just to make sure we're all singing from the same song sheet. It comes to mind when I was thinking about preparing doing this video. I started thinking about the U.S. concept of what's called the House of GAAP. Now, we like to think that we do our accounting according to generally accepted accounting principles, and I think everyone is trying their best, and the auditors are checking to do the checking to see if we're doing things according to GAAP. But the concept of GAAP is slightly elusive in that we have different priorities of GAAP, or hierarchy of GAAP. For example, in our little Adventist world, if I could call it the Adventist world hierarchy of GAAP, we could have at the top level of what we consider authoritative GAAP is IFRS rules. If it's in the book, that's what we are going to go by. But then underneath that, and interpreting those IFRS rules are the Church Accounting Manual. So we have the Church Accounting Manual, who is taking the IFRS rules and applying them in the church context. And so it's the lesser light to the higher light, if you get the idea. All right, but then underneath that is what we're doing in the Sun Plus world. And what we're doing in the Sun Plus world, for example, this document right here, it would be trying our best to interpret the Church Accounting Manual and the IFRS rules into the Sun Plus context. So if at any point there would be a conflict between what we are saying, or I say in this video or in this document, then the accounting manual would take precedence, just like if any point there was a conflict between the accounting manual and IFRS rules, the IFRS rules would take precedence. So it's sort of a hierarchy of authority. But but one of the things that we face in the Sun Plus world with GAAP is that we're in one sense where the rubber meets the road. It's one thing to say something should be done a certain way. It's a whole different way to how to get this software to do it. I should mention that the BDO Sedmans, which is a gigantic auditing firm in the United States, an international auditing firm really, has looked at the Sun System software and has actually issued an opinion, like an audit opinion, saying that the Sun Systems software is fully configurable to meet IFRS GAAP. It doesn't mean the way that we apply it in the Sun Plus world or the way you're using it makes it automatically GAAP, but at least if we use it correctly, it can be used correctly in such a way as it will comply with IFRS GAAP. So our struggle is how to get our heads around all the rules and make sure that they're being applied properly. And so today's topic is how to account for prior period adjustments. And I think you'll be a little bit surprised at what we've come up with. Now, I should mention to you, speaking of coming up with it, is that I've had some pretty interesting conversations with the folks at GCAS. They're completely in agreement with what we're doing here, and particularly they have vetted the document. So I may say something gets off base in this video, but they have looked over the document and in a sense signed off of it as something that they completely agree with. So if you get into a discussion with your auditors about how to do prior period adjustments, then you need to pull the document out and say, look here are your guys, and get them to raise the debate above just your office. But as far as our standards are concerned, we're going to follow this document right here. And so I can't wait. In essence, I'm going over the document with you, so you'll be able to hear my little editorial comments and explanations as we go along. So thank you for watching, and so let's get to work. Thanks a lot. Accounting for prior period adjustments. This video blog is basically going over a paper with the same title that's attached below. Before I start, I'd like to thank Jim Trude from GCAS and Dan Herzl from GCAS and Danny Orelloso from our Sun Plus team here for helping me work on this paper and helping us come to an agreement on the right processes to apply the accounting manual in the Sun Plus world. This video has 3 parts. The first part reviews the accounting rules connected to prior period adjustments. The second part is a case study that shows these rules in action and hopefully brings clarity. The third part establishes the official Sun Plus process for establishing prior period adjustments. How are we going to do it inside of our system? Our first challenge has to do with jargon. Prior period adjustments are accounting entries correcting a prior period error. Prior period errors are simply that, errors in prior periods. The problem comes from defining exactly what an error is. First off, it includes omissions and misstatements. So if you fail to show a building that should be shown, that would be an error of omission. Or if you showed a building but for the wrong value, that would be a misstatement error. In both cases, they were errors and both needed to be corrected with prior period adjustments. Possibly need to be corrected. The definition of a prior period error hinges on the information you had or should have had when you were preparing the prior year's financial statements. It is not considered an error if it were impossible for you to know the information you would have needed to do the accounting properly. For example, suppose at the end of last year you had a receivable from a company that went bankrupt. If you knew or would have known that it was bankrupt, you would have written off the receivable. But if you did not know and there was no practical way for you to have known, it is not considered a prior period error. It would just be a regular write-off in the current period. But if you knew or could have known, it might be a prior period error requiring a prior period adjustment. How about another example? Suppose a building is seriously impacted with the presence of asbestos. This is infestation, so to speak, is to the point that the value of the building is wildly overstated. If you did not know that the building had asbestos at the end of last year and there was no practical way that you would have known, it is not an error in hindsight that the building value was overstated on your statement of financial position. On the other hand, if you knew that the value of the building was seriously impacted by the asbestos, or if you could have known, then it would be an error. Prior period errors include mathematical mistakes, mistakes in applying accounting policies, overstatement and misrepresentation of facts, include fraud. It is useful to talk about what prior period adjustments do not include. They do not include changes in estimates. They do not include events that happened in the current period that affect the value of assets and the liabilities in the previous balance sheet. For example, let's suppose you accrued the last month's electricity expense on last year's financial statements, and you estimated that it would be $90,000, and you showed that as an accrued expense and accrued liability on last year's financial statements. Then the bill comes in for $110,000, $20,000 off. This is not an accounting error. It is an error in estimates, and so that extra $20,000 would be an expense of the current period. An important consideration in this context is materiality. I should mention that materiality is always important in every accounting theory issue, accounting standards issue. If it's not material, then you don't do it. But if it is material, you do it. So if an accounting prior period error causes a misstatement in a previous or current financial statement, it would be recorded as needs to be fixed with a prior period adjustment. If it does not, the prior period adjustment doesn't need to be made. Okay? Prior period errors put both the organization and the organizational auditors in an awkward situation. So we need to be right up front about that. First off, the organization is owning the fact that they have made the material error in a prior year. Also, now the auditor has to own the fact that he or she overlooked the material error in the previous audit. So it's really a time for everyone to have a cool head and a time to include broader counsel whenever you encounter a prior period error. I would never make a prior period adjustment correcting a prior period error without a full consultation with my auditor. The auditor has had a lot of information, may have a lot to add to this situation. First off, since the definition of a prior period error is sort of obscure, it is useful to talk to somebody about it to make sure that it genuinely is a prior period error. Also, the auditor is more skillful at making materiality judgments than accountants usually are. So it's very important, if you feel like you need to make a prior period adjustment, to confer with your auditor before you start and before you make it. Speaking of auditors, there's one sensitive area that needs to be dealt with this presentation. For very good reason, auditors are very firm that once an audit year is closed, no entry should be made in that prior year. Speaking of my previous audit days, there's nothing more miserable than the opening balances of a year being different than the audited closing balances from last year. However, in the context of prior period adjustment, that is not correct. I think you'll understand why we have to open the prior periods and make entries in those prior periods after you've watched the rest of this video. But it's very important for auditors to work with the accountants to understand that that is going to have to be done. In fact, if you make a prior period adjustment, you want to make sure it is well documented in a folder explaining exactly why you made it and where the entry was made, and presenting that to the auditor when they show up. But this is one case where the prior period must be opened and entries need to be made in a previously closed audited period. So once we determine we have a material prior period error, how do we record the correction of that error? Let me first off just state it as a rule, and then through the rest of this presentation we'll look at making sure you understand the rule and looking at some examples on how the rule is applied. So here goes the rule. The accounting rules require that all comparative data shown must be corrected so that they are shown correctly, as if the error had not been made. So in all properly done financial statements, 2 years of data are shown for comparison purposes. I mean, that's assuming that it's not the first year of the operations. So for assuming that it's not the first year of all operations, all properly done financial statements show 2 years of comparative data. So both columns of information must be shown as if the error had not ever been made. So if and the rule, stating the rule again, that all data shown must be shown as if the error had never been made. If you have a constituency meeting and want to show 5 years of financial data, all 5 years have to be corrected to compensate for the prior period error. It is not suitable to put the adjustment in this last year and leave the error, the impact of the error, showing in the previous 4 years. I hope that you understand what that means. We'll go over an example in just a minute. So we'll be going over this several times, so if you feel a little bit confused, just hang on. Let's consider a simple example. Let's suppose last year you got a donated building that you failed to record, and the auditor failed to catch that it wasn't recorded. And also, let's suppose that we are showing the standard 2 years of financial statements, current year and prior year. In this case, the prior year information needs to be completely adjusted as if the mistake had not happened. So the building would need to be increased in the prior year column. The accumulated depreciation would need to be increased in that prior year column. Depreciation expense for last year would need to be increased. Donation income last year would need to be increased. All of this in last year, as if the mistake had not happen. It is absolutely would be incorrect to show last year's audited figures in the prior year column and have an adjustment at the beginning net assets of this year. This is worth saying twice. It would be absolutely incorrect to show last year's audited figures in the prior year column and to have an adjustment in the beginning net assets of this year. In fact, in this case, if the little case that we're looking at, when it was last year a donation last year, there would be no indication on the face of the statements that there were any prior period adjustment at all. There would be a note explaining why the audited figures are different than what is showing on the financial statements, but nothing on the face of the financial statements. So now let's make it a little bit more complicated. Let's modify the example slightly. Let's say that the building was donated 3 years ago. Okay, so now we have 3 years in play in your imagination. We have the current year and and prior year, and then 3 years ago. 3 years ago it was donated but not recorded. The statement of financial position would need to be adjusted for the book value of the donated asset. This would need to be changed in both the current year and the prior year. The activity statement for both years would need to show higher depreciation expense, and somewhere on the financial statements the balance forward of net assets from 3 years ago into the prior year, last year, would need to be modified with an amount labeled prior period adjustment. This statement is a little confusing, and in the upcoming illustration we'll show it more clearly. The point, however, is that the current year and the 2-year set of financial statements, the current year and the 2-year set of financial statements does not have a row labeled prior period adjustment. The prior year, last year, has a row on the financial statements labeled prior period adjustment. So let's get down to our own illustrative case. It might be helpful for you if you open your accounting manual at this point and follow along there. I will be showing the pages from it, but you might feel better having something in your hands. Let's suppose you had prepared the financial statements that are contained on Exhibit 17A. These were the financial statements you handed in to the auditor for his consideration. I'm going to go through them with you now, so you have a sense of what I'm talking about. There's a statement of financial position, the activity statement, the net asset statement for this year and last year. Now the ones that we're looking at here have come directly out of the accounting manual. Now let's pay close attention to the periods, because that's where we'll get confused. The accounting periods here, or let's just say they're 2011 and 2010 financial statements. The current year is 2011 and 2010. We've got to keep the years straight because that's since it's prior period adjustment, keeping what's going on in what year is the whole point. Now let me read the case to you. Let's suppose that you have, with great pride and a sense of completion, prepared your financial statements showing the current year and last year. A comprehensive review of the organization's fixed assets were completed during the audit of this year. The review revealed that on January 1st, very convenient date, the very first day of January of 2007, now that is 5 years ago, in January 1st of 2007, a house worth $50,000 was donated to the conference. Suppose this donation had not been recorded. For ease of calculation, we'll assume a 50-year life for the house. To make sure that, so that's $1,000 a year depreciation. To make sure that we have clarity on this example, we offer the following schedule. Our financial statements showed 2010 and 11, and then we have 3 years who are not shown in the financial statements, 2007, 8, and 9. Okay? So on January 1st of 2007, a donation of $50,000 was not recorded, a prior period error. On December 31st of 2007, let's say, depreciation expense of $1,000 was not recorded for the year of 2007. On December 31st of 2008, depreciation of $1,000 was not recorded. On December 31st of 2009, $1,000 of depreciation was not recorded. So in the unrecorded year, we had $50,000 donation and $3,000 of depreciation. And the unrecorded, the unseen years on our financial statements. So at the end of those 3 unseen years, the book value for the donated house was $47,000 at the end of December 31st, 2009, or another way of saying it, $47,000 at the beginning of 2010, which is the year that we're the first year that is shown in our financial statements. On December 31st of 2010, depreciation expense of $1,000 was not recorded. On December 31st of 2011, depreciation expense of $1,000 was not recorded. So the book value of the donated house at the end of the first shown year was $46,000. At the end of December 31st, 2010 was $46,000. And the book value for the donated house at the end of the final year is $45,000. So we have 5 years of accounting errors, not just the first year, but the depreciation expense for all the 5 years. I'm going to go over the answer in detail, but let me make a few observations. On our 2-year financial statements, the prior year period adjustment will be $47,000. $47,000, that's the $50,000 minus the 3 years prior to 2010. And this will be shown as an adjustment to the 2010 beginning net asset balance. Let's suppose we need to make a comparison of the 5 years for the constituency meeting. There would be no line identified as prior period adjustments anywhere on the presentation. But each year would be shown to reflect the needed error correction. It would be incorrect to simply pick the numbers from each of the year's audited financial statements, including the 2010's prior period adjustment line, and put them on the comparison for 5 years. Rather, the 3 previous years would need to be corrected. These corrections would in fact absorb the 2010 prior period adjustment line. Okay? So, on a 5-year comparison, there would not be any indication of prior period adjustment, since all 5 years would need to be corrected. Prior period adjustments are simply the figure showing as prior period adjustment on financial statements is bringing the error change from previous years into your first shown year. Now let's look at how the error correction would modify the statements as they appear in our hypothetical error correction would modify the statements as they appear in the accounting manual. On the statement of financial position, in the current year 2011, the land, buildings, and equipment would increase by $45,000, and the invested in plant function would increase by $45,000. That is the $50,000 of the original donation minus the 5 years of accumulated depreciation. The prior year's land, building, and equipment would increase by $46,000, and the invested in plant function would increase by $46,000. That is the $50,000 of the original donation minus the 4 years of accumulated depreciation. On the activity statement, both years would show an additional depreciation of $1,000. And at the bottom of the activity statement, we have the row entitled Prior Period Adjustment. But look at that row carefully. Notice that the prior period adjustment amount is showing in 2010, and it's adjustment at the beginning net assets for the beginning of 2010. This adjustment is $47,000. That is the $50,000 minus the 3 unshown years of depreciation. To really emphasize this, notice and consider that there's nothing shown in the current year for prior period adjustment. So the prior period adjustment is adjusting the net assets brought forward from 2009 as the beginning balance for 2010. Very interesting. And suppose there were 3 years shown for some reason. There would be nothing shown there for prior period adjustment for 2010 and there'd be nothing shown there for 2011 and 2010, and the new 2009 column, if there were 3 years showing, would have a prior period adjustment of $48,000. And if there were 4 years of columns of information showing, there'd be no prior period adjustments for 2011 and 2010 and 2009, and the 2008 column would have a prior period adjustment of $49,000. Just the errors flowing from the unshown year in the first year shown. So, and if you were showing 5 years of data, there would be no amounts labeled prior period adjustment. I hope you get the idea. Now let's look at the current year's statement of changes in net assets. The only modification it needs is of $1,000 in additional depreciation. Our real challenge on this prior year net asset statement is showing and explaining the differences in the opening balances. And why are the opening balances for 2010 different than the audited balances from 2009? So this first column is showing the audited balances for 2009, then the $47,000 prior period adjustments, which gives us the opening balances for 2010. And don't forget now, we are making these statements for 2011. So the big adjustments are happening in the prior year statement of changes in net assets. So for some reason, if we were showing 3 years of data, there would be very little changes on this year and last year's statement of net assets, and the explanation of changes in opening balances would be on the 3-year-old statement of changes in net assets, and so forth. So after we've changed the financial statements would need a footnote that read something like, Footnote 3, Prior Year Adjustments. The Sample Union Conference failed to record a donation of fixed assets as of January 2007. This resulted in a restatement of 2010's depreciation expense with an increase of $1,000 more than was shown in the previously issued financial statements for 2010. And it includes an adjustment on the net asset balance forward from 2009 of $47,000. The entire discussion would be about why the prior year's figures are different than the audited statement. Now, some nonprofits bypass adding the prior year adjustment row in the activity statement and the prior period adjustment column to the net asset statement by labeling the balance from the unshown year as restated. Okay, so the opening balance from the unshown year of 2009 in this case would not just be shown with the date, but would be shown with the words restated, see note XX. And then in note XX they would include a table that looks like this that explains why the numbers are different from the audited statement. So it might look something like this. Effective prior period adjustments on beginning net assets January 1, 2010. And then it would have a column called as previously reported in the previous audit, the restatements, and as restated. These would be the as restated would be the figures in the prior year's audited column. So fixed assets, it would show last year, showed what was on the audited statement, the restatement, and the effect of change, and then as restated. Okay, so it went up $47,000 is illustrated here. And how total assets went up $40,000, and then investment in plan assets, how it went up $47,000. And any other types of changes, increase in depreciation from previously reported to how it now looks. Finally, the treasurer should make reasonable measures to destroy all known copies of the old financial statements, the old uncorrected financial statements. This includes the audited and the unaudited ones. Efforts should be made to ensure that users of the financial statements and people who are making management level reports and internal reports and any other types of presentations and spreadsheets and graphs all are changed, and all the historical data is changed to reflect the corrected error. Now, the Sun Plus process. Conceptually, it's very simple to make prior period adjustments in Sun Plus. And in order to prepare the data so a financial statement for any period can be properly shown, it is necessary to record and correct the erroneous transactions in the period in which the error occurred. That is so important, I will say it again. And in order to prepare financial statements for any period, and so that all financial statements can be shown correctly and properly, it is necessary to record and correct the erroneous transaction in the period in which the error occurred. It is not an entry of the current period. In our example case, it would be necessary to open the accounting periods using a ledger setup for all the incorrect periods. In this case, it would be January 2007 onwards. The unrecorded fixed asset would be recorded in January of 2007, and the missing depreciation would be recorded for each subsequent period. Using Word or Excel, the organization must produce an explanatory footnote that explains the nature of the error and shows its effect in a supplementary schedule. This schedule would take the balances from the previously issued statements, the previously audited statements, show an adjustment column for the prior period adjustment, and then the restated column. The restated column would then match the opening figures on the statement of net assets of the prior year. It would look roughly like the illustration on the next page. We're doing 2011 financial statements, but this is a schedule dated December 31st, 2009. Then we have the first column, previously issued statements, and we'd have the information in this first column that came directly off of the audit for 2009. Then we would have the adjustments for the ending balances of 2009, and then we have the restated balance for December 31st of 2009. Okay, and these figures would be the opening balance on our prior year's statement of net assets. And if you made the adjustments in Sun Systems, that is the figures. This figures in this far right column will be the figures that are the opening figures of our statement of changes in net assets and our standard financial statement. So we're clear that this whole thing is being made in an Excel sheet and added to the financial statements. Okay, and so the process is very clear. Okay, to summarize it, we will make the corrections in the period the errors happened. When that is done, the beginning balances on the statement of net assets for the prior year will be correct, but they will be different than the audited statements. And so we will make this sheet right here to explain the differences between the 3 years ago audited statements, the adjustment that happened, and then the opening balances for the prior year statement of changes in net assets. Under this method, the prior period adjustments accounts in the net assets in the 5,000 category portion of the chart accounts would never be used. Okay, maybe I'll say that again. The prior period adjustment accounts that are appearing in the net assets section of the chart of accounts would never be used. How about third time? Prior period adjustment accounts in the net asset section, the 5,000s of the chart of accounts would never be used. Now we have one small topic left to discuss. It is very typical for an auditor to give recommended adjustments after they're done with their audit. However, it is important to recognize that there is no need for the auditors to be highly skilled in the nuances of Sun Plus accounting. So you should make their recommended adjustments, but they should be made following Sun Plus style. That is, what we would like to capture is the spirit of the recommended adjustments and not blindly post to the accounts in the form that comes from the auditors. There's dozens of good examples all through the Sun Plus world of people who have just blindly taken the accounts stipulated by the auditors and posted them without reflecting on their impact when they hit the Sun Plus system. There's no better example of this than in the area of prior period adjustments. It is very common, proper, and right for the auditor to give the organization a recommended adjustment that goes, for example, debit buildings and credit prior period adjustment, or stated exact same thing but is stated a different way, debit buildings and credit net assets. In this case, the auditor is obliged to give as much information and background to the entry as they can. However, it is the organization's responsibility to then take that information and research the situation to enable them to make the correcting entry back in the earliest possible period to make the correcting entry, back in the period where there was the mistake. And they would then ensure that the actual effect of the entry had the same effect as the spirit of the recommended entry. So you don't blindly take their entry, but you make it intelligently following the nuances of Sun Plus. So if the auditor said debit buildings and credit net assets, Well, instead of just crediting the net asset account, you have to reopen the previous periods, make the entry, and in effect, it will increase your net assets. I should have mentioned that if you ever are obliged or feel that it's just impossible to not follow these instructions, it is very important for you to seek further counsel from the SunPlus leadership. Check with your DST or someone else if you feel like it is absolutely necessary for you to do debit or credit to prior period adjustments, and we will help you understand how to avoid that. Well, this brings us to the end of a fairly difficult subject. I'll be happy to answer any questions about this and discuss it further with you. And we hope that you stay tuned and continue to listen to this. And we sure appreciate your support and your interest in learning all you can about SunPlus. Thank you, and we'll see you next time.